right, guys, we're back again with another great episode of PFREI, Passion for Real Estate Investment. I'm your host, Fuquan Bilal. Thanks for tuning in. Really appreciate you guys. Today, we got a great guest. We're actually going to talk about something that we haven't talked about on the show before. So we have Shannon Robnett. That's how you say it, right? Shannon
Yep.
Robnett. So he's here today to talk a little bit about the office industrial part of the business. So multifamily stuff. It's all commercial, and has about 25 years of experience in the business. And I'll let him talk about his background, and then we'll kind of jump into it. I really appreciate you coming on the call, Shannon, and really sharing with our guests a different look at one of the facets of real estate. So we talked about in the show, of course, multifamily, fix and flip, wholesale. We had a few deal sponsors on here talking about, how do you raise capital, a fund, syndication, stuff like that. So by this time, the audience are either active investors or accredited investors looking for possibly some opportunities. So by all means, share your background and we'll jump right into it.
Thanks, Faquan. I grew up in a real estate family. In fact, I told this to Robert Kiyosaki one time that when I read his little purple book, Rich Dad, Poor Dad, I was really unimpressed because I grew up with Poor Dad, right? Everything I learned at the kitchen table, besides my table manners, was 1031s and how to avoid taxes and how to make your investments work for you. And that it really wasn't an asset if it cost you money, it was a liability. And so, with that background, I thought I was smarter than everybody else, and I was going to go to college and do something real with my life. Only to be sitting there a semester into college and watching my little brother make about $45,000 a year in 1993, which was a handsome amount for a guy that didn't go anywhere but high school. And decided, you know what, I was going to go back and maybe rethink this construction thing and development. And so I went out and I started building single family homes, and I quickly realized I didn't like homeowners. There was too much nitpicking and things like that. And so I got into commercial construction. We built police stations, fire stations, city halls, hospitals, gymnasiums, schools, you name it, we built it. And during that process in my career, I realized that the minute I was done with the job, I was done getting paid, but the people that I worked for had created an asset that created residual money. And about that same time, my father retired on cash flow and has not worked for anybody for any reason other than himself since that day, and has really enjoyed that. And so I began in 2001 I built my first industrial investment, and I still have two of the original tenants 22 years later. And that's been mailbox money. That's a very solid asset class. And so then I began to pick up some partners here and there and do projects and everything. And in 2017, I built a 180 unit apartment complex with one partner, one single check writer. And at the end of the project, I had two more lined up, and my partner was a family office, and they decided that they were not going to be investing in real estate in the future. And something that since I've talked with them that they quite regret. But the reality was I found myself in a position in 2000 and end of 2018, beginning of 2019, that I needed capital, and I had no idea how to raise it other than dealing with single partners. And so I quickly learned from a guy who taught me how to syndicate, but not through the normal channels. He came from the movie industry, and if you know much about movies, they don't get a loan to create a $200 million blockbuster movie. They syndicate the capital. They've got the capital stack. They've got the preferred equity. They've got the guys at the end of the tail in the beginning. And so I learned from him how to raise capital. And at that point, we really kind of began to grow at a more rapid pace because we had access to capital. Since that time, we raised almost $60 million. And we've completed about $425 million worth of projects to date. And in the last 6 years, we haven't been a for-hire construction company, development company. We've only performed on our own assets for ourselves and our investors. And so thanks for having me on the show again. It's definitely a pleasure to be here, and look forward to what we can do to entertain your audience.
Absolutely. That was great. Thanks for the background information. I appreciate it. Just like you, we are a company that vertically integrates also our construction. We don't do construction for other people. I always chuckle when people see our residential properties because we do a lot of residential fix and flips. When we done with those, and they go, "Hey, we want you to do this job for us," and I'm like, "Nope, this is one
Yeah.
headache I'm glad to be done with and over with,
Yeah.
and I'm not looking forward to
Yeah.
doing it for nobody else." So
Yeah.
I get
You
it.
know, and it's one thing when you're in at the ground level, right? You bought the fix right. You know, now you're flipping it and you're going to make money as a contractor on that, but you're really there to control timeline and schedule, right? You're really there to make sure that your product gets back to the market very quickly, especially in volatile markets like we have now, and even probably more so in 2021 when prices were shooting through the roof. The quicker you could get on the market, the quicker you could get into the next deal, which was more important at the price you were going to buy your next one at, right?
Absolutely. Yeah,
And,
we got hurt with a few timelines and contractors delaying because they were scattered all over the place and price
yeah,
increase. So that kind of really affected our business like right after COVID going into that effect. Even though values were increasing, we still were getting hit with
yeah,
increase of supply and a timeline being delayed, which
yeah,
holding costs increase. So it's like, okay, that value increase compensate for the delays and everything else. So the profit is almost the same, a little bit
right,
more, but almost the same. But
yeah.
let's talk about a little bit. You mentioned how volatile the market is right now, where we are trying to navigate the narrows in this marketplace. How has that affected your business model? I know you said earlier industrial is kind of resistant through certain things. You had a tenant for 22 years. But some of those places have like the Amazon effect, warehousing. Maybe not, but I know that interest rates and certain things that have happened in the market are affecting a lot of different facets of real estate. How is it affecting your business model, if at all? What are you doing to pivot?
Well, the reality is, I've been doing this for so long. I did my first deal at 9% interest, right? And I think it was an 8.5 cap. So what we've seen over the last, 19, 20, and 21, to me, were an anomaly, right? I didn't change my underwriting during those time periods. And so my conservative numbers still work just fine and will continue to work into the future because I come from a long road here that has shown me that if there's one thing that real estate does, it cycles. And we have feeding frenzies and then we have selling frenzies and all those different kinds of things. And if you're buying it at a 5 cap and the only way your deal works is to sell it at a 4 cap, you probably ought to reconsider that, as a lot of people are now finding out that, well, what if it goes to a 5.5 cap? What if we can't sell it for, the same cap rate that we bought it for? Or what if we can't finance it for what we'd anticipated or what we were quoted because we were delayed? And I've learned a lot of those lessons because I made those mistakes in other time periods. I made those in 2002. I made those in 2008. I made those in other changing markets that didn't change quite as rapidly as this one, but it's definitely one that is catching a lot of people off guard. But I think we're returning to more of a healthy market. I mean, if you really think about it, selling something at a 3.75 cap, which I've done, um, isn't really, there's not a lot of meat on that bone. And if you're really going into deals at that price and you're buying stuff at that price, you better be well capitalized. Otherwise, you're going to have issues as it moves forward. And so we found a lot of people that are getting caught flat footed or, in overpriced real estate. But here's the beautiful thing about real estate, Faquan, is all you got to do is give it time. You know, I mean, if you had a house that you bought in 2008, right? I mean, the day before the market crashed, and you still had that house, you wouldn't be complaining, right? You would be positive on that. Now, it would have taken you 20 years, but you wouldn't have had to take a loss on it. And so, unlike a lot of things, real estate does always cycle back around and it will come back up over time. So, a lot of people that are trying to make day trader type moves in the real estate market are finding that more difficult to navigate than people that are looking at a 5 to 7, maybe even a 10-year window for the performance.
That was quotable. People trying to day trade on real estate expecting what they did in the past to work out, and the strategy is not the same for one. And two is it's a long-term game.
Yeah.
Right? It's a
Yeah.
long term. People get in it just for the short term, right?
Yeah. Well, and the other side of it is when you start talking about long-term windows, when you start talking about even like the BRRRR strategy, right? You buy it, you remodel it, you refinance it, and you repeat that. If you're continuing to hold the asset, you're doing one major thing that your partner probably isn't real happy about, but that's pay taxes. You know, when you're doing something in real estate and having to claim that as ordinary income, you're taking a very profitable item and discounting it by 30% with just what you're going to carve off the top in taxes. Whereas the long-term aspect of real estate, there's a lot of benefit in the tax advantages of holding real estate, in the passive income, the depreciation, the 1031 ability. All of those things take time that a lot of people in the last couple of years have not given their real estate. So while they've made good money, they've also sent quite a bit of it to Washington, D.C. And
Yeah,
they do such responsible things with their money there, right?
yeah, for sure. What? So, Shannon, why are you passionate for real estate investing?
I see how real estate investing is probably one of the very few vehicles that, if you will be diligent with it over a lifetime, you can actually set your kids up to receive money in the mail for their lifetime. You can't really do that buying and selling cars. You can't really do that if you're in the stock market. You can't just set it and forget it and leave it alone and get paid monthly in the stock market with things that provide you with tax benefits. And so I think the more people that know that, the more people that truly understand the versatility that comes from real estate and the ability for real estate to not only pay you today but lower your tax bill at the same time, I think more people have the ability to achieve financial freedom. And that doesn't mean you become, the Donald Trump or the Mark Cuban type of bank account numbers, but it does allow you to dictate what you do with your day and who you choose to spend your time with.
So the asset class that you decided to go into, right? So as we started the show, I said I've interviewed people who's done fix and flips, who's done wholesaling. Why did you pick this avenue? Why did you pick office industrial? Is that something that you think well, I'm pretty sure it has a legacy play, but why that class? Why that part of the business?
Well, let's take a comparison real quick between multifamily and industrial.
Okay.
Okay. So if you look at multifamily, you've got people that are transient. They may be there for a year, right? Sometimes they'll break their lease, but rarely do they stay for 5. They don't necessarily have credit. That's why they're renting, right? Because they can't buy a house. They don't have a lot of money in the bank, probably don't have a really strong balance sheet, right? Those are the people that you're dealing with. On the other side, in industrial, you've got businesses. We've got window tinters, cabinet shops, welding shops, gymnastics facilities. We've got manufacturer of firearms. We've got all different kinds of people that have created businesses that have balance sheets. I would say 90% of the business owners own a home. They sign 5-year leases. But on top of all that, Faquan, what they do is the leases are set up with what's called a triple net. And the triple net, because of the duration of the lease, because I'm willing to commit to you for 5 years for a lease, we got to make sure that my property taxes and my insurance and all of that stuff doesn't eat away all my profit with unexpected things that happen. And so what happens in an industrial lease is we set the rent and we put an escalator in there that will escalate the rent 3 to 4% a year. And then we do an estimate on the triple nets, and the tenant reimburses us for all triple net expenses. So if I lose my lawn guy and the next lawn guy is twice as much, I pass that cost on to the tenant. If we need to repaint the building, I pass that cost on to the tenant. If my insurance goes up and my property taxes go up, that cost gets passed on to the tenant. So it's a very stable asset class for the investor because your rent is really your profit, right? I mean, you take your rent, you minus your mortgage payment, that's all you have as far as a direct expense against your income. And so when you look at a legacy play, we're getting ready to break ground on a facility for an international stone dealer. And they signed a 10-year lease with 3 10-year extensions. And those 10-year extensions, I don't have any say over. If they elect to take them, they take them. But there are rent adjustments at each level of that. Every year the rent adjusts. Every 10 years we have the right to bring it to market. So I'm going to stay current with inflation, if you will, because that's really what escalatory rent is. It's inflation. I'm going to stay current with inflation, and they're going to pay all the property taxes and the insurance and all the things on that. So I can sign a 40-year deal, essentially, with a single tenant get a 20-year note on it, and come back in 10 years and see how everybody's doing, right? And so when you really look at that, it's kind of like what Chef Tony said, right? Set it and forget it. I mean, it doesn't
Yeah.
come with the Ginsu knives, but it really is a legacy play because it's such a hands-off asset class that continues to monitor itself.
Yeah, one of the things that I was really attracted to with the commercial office piece is one of my landlords, maybe like 10 years ago, I didn't understand how it worked. And I said, why are you investing in commercial office instead of residential, like rentals and fix and flips? He was like, that's a young man's game. I played that when I was younger. He said, what we do now, he said, I'm going to take your 5-year lease. I'm going to take it to the bank and I'm going to hypothecate this lease.
Right.
I'm going to borrow against it. And then I'll probably have a few that I'm going to securitize. And I was just like,
Right.
wow, this is
Right.
crazy. They own a lot of buildings in that area, probably to the tune of 600 units with
Mm-hmm.
all the buildings they own. They're securitizing leases, they're borrowing off the
Mm-hmm.
leases, they're doing all this stuff. And I'm like, wow, that's insane. I know
Yep.
you do that with office. And he's like,
Yep.
office is where it's at. So I get it. It's
Well,
just,
you're hearing right now that office is in trouble, right? But as an entrepreneur, which I know you are, that means that 12 to 24 months from now, there's going to be some real deals to be had, right? There's going to be some opportunity to then come in. I mean, I bought an office building 2 years ago that I actually got the owner to carry $3.8 million. We came in with 20% down at 6%. He carried for 2 years. It was 65% vacant. We've now got it 85% full. We're getting ready to take it to the bank. We've got about 6 million total in it with the loan and with the tenant improvements that we did. We'll probably get 7.5 million at the bank. So we'll return all the investors' capital. We'll have some profits coming out on a building that's now worth $10 million,
yeah,
right?
that's awesome.
And so, I wouldn't want to go into the heart of Houston, Texas right now with all that office vacancy that's coming online today, but I wouldn't mind be kicking around in there in about 12 months when stuff starts to get cheap.
Yeah, yeah, yeah. I saw some opportunities come through on 10X, it's the auction site, I'm pretty sure you know.
Oh,
And it was
yeah.
an office building around where I live at, and I couldn't believe they were getting rid of this office building. It's an A plus building, like really an A plus area, A plus building. Vacancies are out of control, but it was on sale for literally 35 cents on a dollar. I mean, that was the starting bid. I don't know where it ended off at. I'm pretty sure it probably ended off 60, 70 cents on a dollar, but I was just like, wow, it's coming and it's coming
Mm-hmm.
fast. Like you said, a
Yep.
year from now, it's gonna be a lot of great opportunities. But I like to go deep in when I'm in and don't like to like jump in another part of the industry I'm not experienced in. But being a passive investor and someone who has experience, I definitely would be all over it, knowing that they had got a super discount and where that market is going to go. I want to get in when it's low because it's nowhere, like you said, over time. If
Right.
I'm a part of that syndication as a limited partner or maybe GP, if I can somewhere squeeze into the GP side, that'd be a
Well,
great win.
well, and then the other thing you got to look at too, and this is your world, fix and flip. Okay, so it's office now. What can it become? Right? What are some of the other things you can do with it? And as the price comes down, people will return to the office space because instead of paying 27, they're paying 17 or they're paying 7, right? There comes a point when people now find it very acceptable to occupy your space. And it's just about understanding the numbers. And I would challenge you on your thought process here about going deep. I believe you are going deep in a market. And this is the thing that I encourage a lot of
I
people to
like
do.
that. I like
Go
that.
deep in the market, understand your market. What market are you in right now?
I'm in New Jersey where I do
Okay.
fix and flips, and then in the Southeast we do a lot of multifamily rental stuff, anywhere from
Okay.
40 units to 120 units.
So if you're going to take a market, go find a market in your area that you really like the demographics on. You like that there's job growth. You like that there's low vacancy, that there's wage growth, that there are people moving into the area. And when you see a hot area, I tell everybody all the time, I would rather do a good deal in a great market than a great deal in a good market. I mean,
Mhm.
you could own the finest corner in Chicago, but you're probably not going to see the kind of appreciation that you're going to get out of Raleigh, North Carolina, right? Or Orlando, Florida, or Dallas, Texas, because those are markets that people are moving into and cash is pouring into and businesses are opening up in. And so if you're looking at that and you're going, you know what? I'm really good at the fix and flip game. Okay, great. take that next market and go, you know what, this market, it's not a nobody can fail market, but the market is going to do more for you in your deal than you are going to do for you in your deal. So you
Oh,
take that southeast market that you like, and you look at it and say, okay, now I'm doing a multifamily here. What else is needed? Hey, I can see that office vacancy is high here, but industrial vacancy is low. Great. I like that. And I can see that U-Haul is telling me that people are moving in droves over here. And I can see that there's job growth and there's new businesses open. You know, most of the Marcus and Millichap, Colliers International, Cushman and Wakefield, most of the commercial brokers have these reports on their website for almost every major city in the nation. So you can go through there and you can find out what market is hot. So now you're doing depth in that area because you're already doing multifamily there. Why not pick up some other asset classes because you know the market? And then you're doing all the same things in one area and you're going deep.
that makes sense. I love that. Good deals. I'd rather do a good deal in a great market than a great deal in a good market.
That's right.
A lot of quotables today, man.
There you go, buddy. We don't charge for those. We don't charge for those.
I love it. I love it. Yeah, I mean it's amazing. I love doing these interviews because I learn something every time. Although I've been in the business for 24 years, that's what I like about real estate. You will never learn everything. You'll always be
No.
learning every single day.
Yeah.
It's like this puzzle that you never figure out, and you get excited when you get to place another piece on the board, so to speak.
Right.
So
No,
yeah,
totally agree.
yeah, let's give the listeners an opportunity where they can reach out to you. If you have some opportunities on joint ventures that is available as limited
Yeah.
partnership, what does that look like?
You know,
Right.
the easiest place to find me is just at shannonrobnett.com. I like to keep it simple. You know, being a contractor, you got to be able to write it down, and first and last name should be pretty good. But shannonrobnett.com, you can see what we got going as far as projects underway. You can get on our newsletter, kind of see what's coming up, see what our deals are like, where we're going with stuff. You can see my podcast on there, and I think you're going to be a guest on mine here pretty soon. And then if you want to talk further about what we're doing, my calendar's there and you can book an appointment and we can chat about what we might be able to do with you.
I appreciate it. And with the markets, we didn't talk about the markets that you're in.
Well, I'm in Boise, Idaho is where my offices are, but we're in Houston, Texas, Raleigh, North Carolina, Nashville, Tennessee. We're in Florida and Washington as well. So we kind of what we did is just like I was telling you, we look at a market and we find a hot market, we find a good strong market, and then we go looking for deals. We don't just wait to see what comes scattering across the email or the broker's throwing out, and we got shiny objects syndrome, right? We're chasing from Tallahassee to Tampa and we don't even know where we're going.
I laugh because I have brokers that I send information to and say I want to specifically focus on this part of the Southeast, which is Georgia and Alabama. And now
Yeah, but Oklahoma's close.
I'll see a really good deal in Tennessee and in Florida, and I'm
Yeah,
like, I'm not there, guys. They're like, you said the Southeast. I'm like, listen, I'm laser focused on going
right.
deep in
Yep.
these markets, even though it's a smoking deal with a excellent cap rate for this market. I'm not going there. And I'm not
Yeah.
chasing squirrels. So yeah,
But you
appreciate
know
you.
what? I mean, and there's a lot of wisdom in that, right? You're starting to do the transition already from the young man game to the older man game because you're not chasing everybody. You're not chasing every deal. You're looking at it and going, man, I know exactly what I want and I know where to get it.
Yeah, and I don't want to be in trouble. There's a lot of people who are in trouble right now, biting off more they can chew
Yeah.
and really depending on taking that short-term money, thinking that the market was going to stay low forever. They were
Right.
able to refinance it to a lower rate. So in another year, not only you're going to see some office stuff available, you're going to see a lot of these funds and people who made wrong projections pivoting to exiting, or unless they're doing cash call to the investors and getting more capital to buy down the rate or do something. But yeah, thanks for coming on the show, man. I really appreciate it. Another great episode, PFREI, Passion for Real Estate Investment. Be sure to check us out on YouTube. Be sure to like and share this. Some very valuable information. Really enjoy speaking to you today, man. I appreciate the value added.
Thank you, Faquan, for having me on.